Hey, it's Ty Crandall with Credit Suite, and in this short video, we're going to talk about exactly who can get funding through the Business Finance Suite. I highly recommend before you submit any customer, especially for direct funding, that you go through this short video to get an idea of who can and can't qualify for business financing. So I call this the 3 C's of lending. There are 3 types of people that can actually get money from us through the Business Finance Suite. The first is somebody that has cash flow of $10,000 a month or more deposited into their business bank account. The second type of person is somebody that has good credit, good personal credit or business credit. The third is somebody that has some kind of asset or collateral. Now keep in mind, I'm only talking about people that are looking for business financing. So if they're coming in to go through the initial steps to build their business credit, anybody can build business credit. But when it comes to somebody that's looking for an instant loan or credit line, for example, these parameters will prevail. So let's dive in a little bit deeper. Does your customer have cash flow as verifiable per their bank statements? Well, one of our absolute most popular programs is revenue lending, or there's also a sub-program to that called merchant advances. Now this is fast money. I mean, this could easily be secured in 3 to 7 days. We've even had closings take place in as little as 48 hours. So this is very fast money. This is also very easy money because somebody can qualify with credit scores all the way down to 500, and they don't need any kind of collateral for approval. They don't need financials or tax returns or all the complicated things that are needed for much bigger loans. And all that's needed for approval is a 6-month bank statement and merchant statement review, and a customer can actually get approved. Now, loan amounts are equal to about 8 to 12% of the annual revenue, and they can get approved for up to $500,000. So I like to make this simple and just say that they can usually qualify for up to about 10% of their annual revenue. So if we look at an example of that, if they have $120,000 in revenue per year, they're going to get about 12 grand. If they have $500,000 in revenue, they can get up to 50,000, and so on and so on. So whatever their annual revenue is, they can usually get advanced as much as 10% of that revenue in a very short period of time. Now, if they have tax returns that show good revenue and profits, and they also do have good credit, then they also might qualify for alternative SBA loans and private money. There's a lot of different programs that fit into this, including $150,000 credit lines. So there's 10-year term loans. So there's a lot of financing that's not SBA. It doesn't take 6 months like many conventional loans do, but if they have good tax returns and good credit, they can get these. The other one I told you about, they don't need good credit for revenue lending. All they need is consistent revenue per the bank statements. And one thing I want to throw in here is to make sure, if it looks like your customer qualifies, that you actually review the bank statements. I can't tell you how many customers say they have $10,000 a month in revenue when bank statements will then show they only have $5,000 a month, and then when you approach them, they have a big long story about why it doesn't add up. So first, make sure that they tell you that they do have $10,000 a month or more going through their bank account per revenue lending, and make sure you look at the bank statements before you submit the deal to actually verify that that's the case. So the next question, does your customer have excellent personal credit or have a guarantor who does? Well, if so, then unsecured credit cards are a fantastic option for them. They can get $10,000 to $150,000, and they're usually going to get approved for as much as 5 times the amount of whatever the highest credit limit account reported is now. So let me give you an example. Let's say they have a $10,000 credit card reporting on their personal credit report now. Well, that means they could usually get up to 5 times that amount, or $50,000 through this program. Now, there's this business credit reporting, no consumer reporting. So that means these accounts report to the business credit reporting agencies. So they build business credit as well as get up to $150,000 in money, even if they are a startup business. They don't need tax returns. They don't need financials. This is a no documentation program. Now, there is another program that does have credit reporting in case they don't have really, really good credit. So let's say they have a 670 or a 680 score instead of 700. Well, then they might be presented with another option of consumer credit cards that don't have the benefits of the business credit cards, but the primary program of unsecured business financing has to do with unsecured business credit cards that report to the business credit reporting agencies. Now they can get up to 5 of these different kinds of cards, which creates competition, helping them get even higher limits, and as they negotiate their accounts down the road, getting even higher limits and limit increases as they go. These cards usually come with 0% intro rates for 6 to 18 months, so they're perfect for startups because this is the crucial phase where they need to conserve as much money as possible. And normal rates on these are really no different than normal credit cards, usually 5 to 25% after that, and there's usually a 10% fee from the actual lender. The customer does not need to pay up front. They can actually get the cards and then pay the invoice using the cards that they actually go to get. Now keep in mind, this is not a credit line. These are actual individual credit cards that they're obtaining. So excellent personal credit or a guarantor with excellent personal credit is required. You're looking for somebody that has no derogatory items at all and a credit score that's usually about 700 or higher. They have to have revolving credit accounts now with $2,000 limits or higher, and they have to have low inquiries, about 3 or less in the last 6 months reporting, and their utilization overall and on their individual accounts should not exceed 30%. So if they have a limit of $1,000, then they shouldn't exceed having a balance of $300. And if they meet this criteria, then they can typically get approved. And again, this is a fantastic program because in our experience, we haven't found anything else that will give somebody this much money on a no documentation program, even if they're a startup, no matter how good their credit is. So this really is one of the best programs we've ever found that's out there, that if somebody does have good credit, it's easy to qualify and get a substantial amount of money. Now, the next question is, does your customer have collateral that can be used to offset the lender risk? So for example, there's a lot of different kinds of collateral that a business might have that they can actually use as leverage to collateralize the money that they're borrowing, or basically to offset the lender's risk. So account receivables, purchase orders, 401k, stocks, a book of business if they're an insurance agent, equipment, and inventory are the most common kinds of collateral that could be used. Now, things that cannot be used as collateral include things like vehicles and tractor trailers and trailers. Vehicles are depreciating assets. A personal home, money in their personal bank account or business bank account. Those are things that will not work as collateral when it comes to business lending, but the things you see listed here will work. As a matter of fact, account receivables, 401k, and book of business are the most common forms of collateral that we find used for collateral-based financing. So with collateral-based financing, your customers can get rates of 5% or lower. This is the lowest interest rate that they'll get on any kind of business financing, even SBA loans. They can usually borrow 50 to 100% of whatever their collateral value is, depending on the amount being financed. So for example, with a 401k, they can borrow as much as 100% of what's in that 401k, whereas if they're actually borrowing against equipment, then they might not get more than 50%. So it depends on the amount of collateral or the type of collateral they're actually using. Cash flow and credit are not strong determining factors. So that means you can have somebody with 300 or 400 credit scores and still be able to get approved for collateral-based financing and still get really good rates, even if they're just starting their business. So for all programs, this short video is a general guide of who may qualify for financing. Some might meet these requirements and still not qualify. Okay, some things that can prevent qualification include current bankruptcy or recent tax liens, high-risk industry such as financial services, unpaid or outstanding current loans, evidence that they're going out of business or behind on rent. These are some things we've seen come up that would decline or have gotten a deal declined that would meet the basic approval requirements. So make sure that you set your customers up with the right expectations. What I've set forth in this video is simply a basic guide of who may and may not qualify for business financing. This is why you're submitting the deal, which will require a deeper look from our finance officer. Sometimes some of these things don't even come up until the file is actually with the lender. And again, some of these things aren't as severe if they have compensating factors. So for example, they might be in a high-risk industry such as financial services, but we've still been able to get those deals done because they have really good time in business or really good credit, for example. example. These are called compensating factors. So even if they have something that would normally get a deal declined, if they have strong enough compensating factors, it might even help them overcome that item, whereas somebody that doesn't have as high a strong enough compensating factors might still get that deal declined. So again, to look at this micro level, we need that file to be submitted so our finance officer can dig in, so the lender can dig in to make sure they meet the requirements. So always let your customer know that there are some things that could hinder their approval, even if they do meet the basic requirements. So make sure you get your customer pre-qualified first before submission, and only submit those that do show as qualified. Our finance officers will not contact your customer unless your customer actually qualifies for business financing. So make sure that you go through your back office to the finance qualifier to see what they can qualify for, or you can go directly to the link at suitelogin.com/courses/finance-qualifier. This video is simply meant to be as short as possible overview of who can and can't get financing. Please keep in mind, in the live webinar section of your back office, there are many hour-long webinars where we go through in-depth how these programs work, who qualifies, rates, terms, and etc. So make sure you dive in to get even more information. So again, this is Ty Crandall. I hope you enjoyed this walkthrough of exactly who can get financing and exactly how to go about using the qualifier to get those customers submitted for approval.